In this part, we discuss the theories and share some key discursive questions topic in our discussions on the business finance. Okay, first discussion part is about the WACC, the weighted average cost of capital. So we need to explain what is WACC, and next is what's the problem and limitation of WACC. The WACC is the effective after-tax cost of different sources of finance used by a company. So the key words here is the after-tax cost of different sources of finance used by the company. Okay, the cost of the different sources are normally weighted by the market value. So key point is the market value. Definitely, if the question asks you to use the book value, then you have to use the book value. But in a lot of cases, market value prevail. Okay, so bear in mind market value should be adopted in your calculation of WACC. And WACC is often used to discount the incremental cash flows of the investment in order to estimate the NPV. So WACC is good because WACC is used as the discount rate to all cash flow generated in future, so that the NPV can be found. The NPV is directly linked to the shareholders' wealth or the company's value. So WACC is highly respected in financial management topic. So WACC is very useful to assist in project evaluation and the measurement of wealth creation. But the problems and limitations of WACC is sometimes it's not clear about whether or not to include short-term finance such as overdraft in the estimate of weighted average cost of capital. So in general, we don't include any OD. Okay, we don't include overdraft in the WACC calculation. And sometimes it is limited in the usage. For example, when it is a significant change in the capital structure of a company, you have to re-estimate the cost of capital. The current cost of capital cannot be applied, and also you have to consider the business risk of the company changes as a result of investment. So don't forget, we have the project-specific cost or the project-specific cost of capital, because sometimes the company decide to expand into different business, then the business risk will be different as well. So you have to estimate your project specific cost of capital if you invest in a company with different industry as what you are now working at. And the investment has complex tax payments and tax allowance, then it is quite difficult to apply the WACC as well. So next topic is about the Modigliani and Miller's theory with tax on cost of capital, assumptions, and limitations. For MM model or MM theory, it relies on restrictive assumptions, including, for example, first, no assumptions, no transaction cost. The second is that is irredeemable. And the third one includes corporate tax only and earning and before interest in tax are constant. So it seems that a lot of these assumptions are not valid. And practical limitations, for example, debt is risk-free. Is it true? In practice, there will be a risk premium on corporate debts for defaults and other risks. And for corporate tax, it assumes the corporate tax relevant, but not the others. Sometimes personal tax are very important, especially it will influence the investors. The individual investors require rate of return, so that the cost of the capital will be affected as well. And in the MM theory, the bankruptcy risk, it ignores the bankruptcy risk. Okay, so in the model, there's no gear, no financial risk. You just ignore the possible effect of bankruptcy costs. Okay, next, we discuss the assumptions and limitations of capital asset pricing model. So for capital asset pricing model, remember the formula. Okay, here is the capital asset pricing model formula. What it assumes is it has the risk-free rate, it has the market risk premium, it has the beta. Okay. So under CAPM, capital asset pricing model, the return required from a security risk that cannot be eliminated by its shareholders. So the shareholders can only eliminate all unsystematic risk. For systematic risk, it cannot be eliminated by diversification. And the assumption is that shareholders hold a sufficient number of different companies' shares. However, the above assumption may not be true, and CAPM may be of limited use in practice. But in general, it only assumes the systematic risk. Yes, it assumes no unsystematic risk because investors have a fully or well-diversified portfolio. And further, the CAPM requires the estimation of expected risk premium here. So it's expected rather than historical. It is similar difficult to determine the risk-free rate. But different debt instruments have different risk exposure, so it just assumes the same as the government view. Okay, seems this assumption is not very realistic. And also shareholders are assumed to be risk averse and therefore demand higher returns in compensation for increased levels of risk. And beta, factors based on historical data, may be a poor basis. Beta, okay, because it only based on the historical data to get the beta in the formula. So it's not good, or even it can be a poor basis for future decision making, since the evidence suggests that the beta values fluctuate over time. And here, the next question is asking you whether any advantages of the convertible debt issue rather than the strict equity or debt. Companies normally issue convertibles in the expectation that the holders will exercise their options. And convertibles can be therefore seen as a form of delayed equity. So first of all, they are attractive. They are attractive to the shareholders, to the firm as well. However, there is also a risk. The share price will not rise in line with expectation at times of the issue, and the holders will not therefore convert. So, because why is it attractive? Because when the convertible bonds issue, it has a lot of projects to invest, and a lot of prospect future will be shared to the shareholders. And for the third one, if the loan notes are dated, the company must have funds in place to allow redemption on the due date. So redemption is possible. The company has a pool of funds for the redemption. And four, convertibles as short-term benefit is that interest payment allowable against tax, and also convertible interest is lower. So convertibles therefore may form part of the strategy of a company whose objective is to raise new equity, but which for various reasons does not wish to go directly to the market in the short term. And sometimes they offer preferable to straight loan, okay, because the convertibles do not commit the company indefinitely to the payment of large interest bills. And the investment base can be widened because some investors, they are just looking for some guaranteed short-term income. So it's a chance to widen your investment base to reach those investors seldom invest in equity. So SME. So why SME have difficulty in obtaining appropriate sources of finance? First of all, SME is small. Okay, it has very limited asset. So SME for SME, it is quite difficult to assess appropriate source of funds because, as I've said, the net of assets available to offer as collateral or security I just mentioned to you is quite difficult to do it. So it's one of the issues that restricting SME to obtain appropriate sources of finance. The other one is uncertainty concerning the business. Okay, because the SMEs is sometimes they are new, they are young. The overall business model is also too young. There's a lot of uncertainty about the business, and for those SME, they may not have enough experiences to handle those uncertainty. Okay. And the third main issues involved is the source of finance for business startups or very new business is also very limited as well. And they don't go to the SME or traditional SME. And here we just update you the some key points about the Islamic finance. For Islamic finance, the major issue is about the interest, or they call the riba. The concept of riba is it allowable or is it accepted in the Islamic finance? It doesn't. Okay, it's not accepted because they have to follow the Islamic finance rule, and for the riba, okay, it is the predetermined amount received by the provider of finance, in which it is absolutely forbidden in Islamic finance because the riba can lead to allocational inefficiency, directing economic resources to suboptimal investment situations. So in Islamic finance, riba is forbidden, and because riba can lead to allocational inefficiency. And here we discuss different type of Islamic financial instruments, and I would like to focus on sukuk. Okay, it is the certificate issued which are linked to an underlying tangible asset, and which also transfer the risk and rewards of ownership. So you have to bear in mind what is sukuk.